On Point with Craig's Investment Partners.
All right, good morning, all. Remember, the information provided here is general in nature. It's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All objectives are subject to risk and none are guaranteed. So, before you make any investment decisions, you should contact an investment advisor. And you can find out more about our services in that regard at our website, which is craigsip.com. Right, I wanted to talk today about central banks potentially ending their monetary policy tightening cycle. We had the Reserve Bank of New Zealand and the Federal Reserve in the US both increase interest rates, policy interest rates, again during the month of May. And while you can never be sure, that could potentially have been the final increase of this cycle from both of those central banks. For the RBNZ here in New Zealand, their projections do suggest that the OCR, the official cash rate, is now as high as it will go this cycle and that it's at the top. Things are a little less clear in the US. A couple of weeks back, we would have probably said the same, that the Fed was done. It had increased rates enough and that it was about to pause and stay on hold. However, we have had some stronger economic data of late in the US, and we've also had some stronger inflation figures than we expected. So the jury's out. Some economists believe that the Fed has done enough, and others believe there is a risk that they might move again. But either way, I think we're very close to the top of that interest rate hiking cycle for both the Reserve Bank here in New Zealand and the Fed in the US. So the big question then is, what does that mean for investors? Financial markets, asset prices, shares, bonds. Presumably that's a good thing, right? So let's take a look at what's happened through history in that regard. But first, where have we ended up? The OCR is now at 5.5%, so it's increased 12 times since falling to that record low of 0.25% that prevailed through the pandemic. So the first increase came in October 2021. And we saw one in May 2023, which many people suspect will be the final one. So the OCR is the highest it's been since late 2008. However, and a lot of people point this out to me regularly, even at 5.5%, it's still well below the 8.25% that prevailed heading into the GFC. So even for people who maybe haven't had a mortgage for more than 10 years or so, people that are newer to financial markets, people that are newer to following these things, they probably think 5.5% is very high. But anyone who remembers the GFC days in the lead up to that period, sort of, and I'm talking 06, 07, 5.5% is not super high. It was at 8.5 back in that period. And if you go back further, certainly to the 1980s, it was higher again. However, what I think people need to acknowledge is that the speed with which it's increased this cycle has been phenomenal. So don't underestimate the impact of that. Even though it's not sitting as high as we've seen in the past, the speed with which it's increased has been significant. So in those 20 months, going back to October 2021, we've seen our official cash rate rise 5.25%, which is significant. And when I look back through history and look at all the 20-month periods out there since the OCR came into being, the biggest increase before this over that sort of time frame was merely 2%. So 5.25 is a significant move. 2% is the most aggressive that we saw through a 20-month period, and that was way back in 2001. And that's why when you look at mortgage rates and you look at the change in mortgage rates, the increase over the last 18 months, the last year and a half, and I forget how much they've increased by, but we've seen the most dramatic increase since 1986. So it's not just about where the OCR and where mortgage rates have ended up. We all know that they've been higher through history and in quite recent history. But I think we've just got to acknowledge the speed with which they've got there. And that's something that I think the RBNZ is very aware of. They'll be very conscious of the fact that we haven't seen the full impact of that yet because they've increased so much more quickly this cycle than in others. The economy hasn't yet caught up. So there's still a bit of that economic weakness to come. And some of the work that they've done in terms of tightening monetary policy, they haven't seen all of the effect of that. So that's important to remember. So, similar story in the US. In the US, the Fed funds rate, and they do a range. They don't just have an OCR at this point. They do a range. So the upper bound of that range is 5.25%. So the range is 5.0 to 5.25. But I'll talk about it as if it's we're talking about the top of that range. So the upper bound of the Fed's funds rate is equal to the level it got to during the GFC. So for us here in New Zealand, in the lead up to the GFC, we were much higher. But in the US, they're actually back at where they were. 5.25 was where they got to in the lead up to the GFC. And to find a time when, so they're equal now with that, to find a time when interest rates, the Fed funds rate at least, has been high, you've got to go all the way back to 2001. So at the moment, equal with pre-GFC. If the Fed did choose to move one more time, as some people think they might, then that would sort of put them at levels that we haven't seen for more than 20 years. And just like here, the pace of that tightening has been very rapid. So the FFR, the Fed's funds rate, has increased 5% in 14 months. They started a lot later than us. We started tightening monetary policy in mid 2021, and in the US, they didn't really start moving until early 2022. So it's been 14 months that they've taken to move 5%, and that is something we haven't seen for a long time. The last time we saw them move as quickly as that in a short space of time was in 1981, and that's back when Ronald Reagan was president, and a chap called Paul Volcker was chair of the Federal Reserve. Today we've got Jerome Powell. Volcker was Fed chair from, I think, 1979 to sort of about 87-ish. Very famous Fed chair. So what does that mean for markets? Well, I guess on the face of it, you would think that when central banks reach the top of the interest rate cycle, that's a good thing. And it is for the most part. At least we know where we stand. Interest rates have gone up as far as they'll go. We don't have to worry about more coming. There's still things to worry about, but at least we know where we're at. And that typically has been a good thing. I went back and looked at all the times in the US that the Federal Reserve has sort of reached the top of the hill, to use that sort of metaphor, each time that they've paused, and there's been 11 times when they've got to the top and had the luxury of pausing, and on 7 of those occasions, so 7 out of 11, the US share market was higher 6 months later. And looking out 1 year later, 2 years later, the US share market was higher 8 out of 11 times and 9 out of 11 times. So most of the time, it is certainly a good thing for the US share market that the Fed sort of hits the pause button and reaches the top of the mountain. That was certainly the case. It was the case in 2018, in 2006, in 97, and 95, and 1984. Those are some of the times when it turned out to be a good thing. The bond market, an even stronger track record, and those 11 times since 1980 that the Fed has paused, the bond market has delivered positive returns in every single example over all of those timeframes. So if you look at the 6 month afterwards, the 1 year, the 2 year, in every single one of those 3 scenarios and all those 11 examples, bonds have always been up. So you can have a high degree of confidence that fixed income markets or bond markets will perform well when central banks hit the pause button. With shares, it's a little bit murkier. Most of the time they do. but not always. So we'll talk about why in a minute. But New Zealand statistics tell a similar story. And in New Zealand, I just looked at the period since the OCR has existed. It came into being in 1999 officially. So since 1999, there have been 5 examples of the Reserve Bank pausing, reaching the top of the hill and then saying, look, we've done enough. So from here, we'll pause and we'll go sideways. And then sort of eventually things usually come down. So those times came in 2000, 2002, 2007, 2010, 2014. And maybe we've seen one, in May 2023. So if we look at those 5 examples and we look at the performance of the New Zealand share market in the 6 months following the pause, 3 out of 5 times the market was up. So 60% of the time, the market performed well in those following 6 months. Not a bad track record, 60% hit rate. If you look over 1 year and 2 years following the pause, the odds of the market being up improve to 80% for both, and the returns sort of go up as well, the average returns. Fixed income, and this is a very similar story to what you see in the US. Fixed income is much more reliable in terms of performing well in the wake of those central bank pauses. So in those five examples, fixed income went up in every single example over 6 months, over 12 months, over 24 months. And even during the times when the share market did perform well in those first 6 or 12 months, fixed income performed better, had higher. So not only did it have a better hit rate, but it had higher average returns. So that's not hugely surprising if you think about the economic cycle. Typically, when central banks stop increasing interest rates, when they sort of reach the top, it usually means we're heading into a tougher economic period, because the economy then has to contend with those higher interest rates, higher borrowing costs. That sort of eats into growth. It sometimes causes a recession. It almost always causes an economic slowdown. So that's as you would expect, isn't it? When you reach that point in an economic cycle and monetary policy tightening stops, that's typically a period that is much friendlier to fixed income, because what happens then is interest rates out there in the market probably go sideways, and eventually they start to go down as the cycle sort of slows and the effect of that tightening sort of comes through. So you'd expect fixed income to perform better, and history shows that it does. However, the end of a tightening cycle can also be good for shares, and there's plenty of occasions where it has. It's just that in that immediate aftermath, they sometimes have a bit of an up and down period. They can sometimes experience sort of a bit of a rocky performance, and then they ultimately bounce back stronger. So same would go for property, I would expect, and that probably that's obvious. But it all depends on the economic climate. It depends as where prices are at, valuations are at when you get to that point. And I think, that's something that we've got to be very conscious of. And some of those examples I mentioned in the past, where shares and bonds and fixed income, bonds and fixed income, the same thing. I'm just sort of interchanging the terminology there. Some of those periods in the past where both those asset classes have done very well. Some of those ones I singled out in the US, like 84, 95, 97, 06, 2018, you had quite different economic conditions to now. At the moment, a lot of the economic indicators are looking a little bit weaker. Inflation's looking a bit higher and a bit more persistent. Bank credit is a little bit tighter, and certainly in the US, you've got a yield curve that's more inverted than at other times in the past. The yield curve is the relationship between short-term interest rates and long-term interest rates, and it's a good indicator for where growth is headed. So all of those things point to inflation that's a bit more problematic than in previous instances, and potentially a sharper slowdown. So I think there's still reasons for us to be a little bit cautious this time, and not just assume that because the central banks have paused that it's full steam ahead. I think with fixed income, you can be a lot more confident that the outlook looks brighter now. Now that we've reached that sort of top of the hill, or we're very close to it. Well, for shares and property, I think it's a bit murkier. The future returns, at least over the next sort of 6-12 months, probably depend a little bit more on the growth outlook there. And to have full confidence in that regard, you need to see evidence of lower inflation as well as better growth. And there's obviously still that catch up to play because of the speed that the interest rates have gone up. But that's not a bad thing either, because as share investors or property investors, we're always looking for opportunities to do more buying. So if it's going to be a bit of a rocky road over the next 3, 6, 12 months, then that's fantastic for those of us that are long-term investors, because we can, keep buying at reasonable prices. We don't want things to sort of rocket back up again too quickly, because that means we've missed the opportunity to keep buying. So I'm quite enjoying these uncertain markets, because as a long-term investor, I want to keep putting money to work. And while we all want sort of prices to rise and markets to perform well, we don't want them to sort of race away on us too soon, because we're enjoying sort of taking advantage of these attractive prices. So you've got to be careful what you wish for. But I guess, long story short, it's not 100% clear that we've seen the last of the interest rate hikes for this cycle, but many people think we are probably done in New Zealand. If we're not done in the US, maybe we've got one more, maybe we're done. But either way, I think no matter how you slice and dice it, we're very close to that point. And that's a good thing, certainly a good thing for the economy. It allows us to we know how long the piece of string is now. And while it doesn't guarantee smooth sailing for asset prices, it absolutely brightens the outlook and does put things on a much sounder footing. So it's something that we should be celebrating that as investors and as financial market followers. It's an important turning point for where we are in this cycle. And if you want to know more, I wrote a report about this. You can get it from your advisor. If you're a Craig's client, you'll find it on our client portal. But I did run the numbers for all of those periods through history that I've talked about, and so you can see the outcome of that analysis. Where did interest rates peak through all of those examples through history? What did the share market, the bond market, the fixed income market do through the following 6 months, 12 months, 24 months at all those points in time? And what do the averages look like? And draw your own conclusions about what may or may not happen this time. But it was an interesting piece of work to do. So I would encourage you to take a closer look. And as always, if you have questions, if you have thoughts, if you need any sort of guidance or help with managing your wealth or talking about your portfolio, we always welcome new clients or people that we haven't engaged with before. Just hit us up. Easy to find our contact details on our website or elsewhere, or you can just track me down and send me a message in some shape or form, and I will make sure that someone gets back to you. All right, thanks team. Talk again soon.
For more insights, visit craigsip.com.